Liquidity pools are the foundation of automated market makers. These pools consist of token pairs that are locked within smart contracts. Let's examine how an ETH USDC liquidity pool works. The pool consists of both Ethereum and USDC tokens locked inside a smart contract. Liquidity providers, also known as LPs, contribute to these pools by depositing tokens. They must add equal values of both assets in the pair. When LPs deposit their tokens into the pool, they become part of the available liquidity. In return for providing liquidity, LPs receive special tokens called LP tokens. These LP tokens represent their ownership share in the pool and can be redeemed later to withdraw their deposits, plus any earned fees. These liquidity pools enable trading by allowing users to swap one token for another. When a trader wants to exchange ETH for USDC, they send ETH into the pool. The smart contract automatically executes the trade based on a predefined algorithm, sending USDC back to the trader. The key benefit of liquidity pools is that they provide constant liquidity for traders, with trades executed automatically. The smart contract maintains balance within the pool according to specific formulas, which we'll explore in the next section. The constant product formula is the mathematical foundation of most automated market makers. The formula states that the product of the quantities of two tokens in a liquidity pool must remain constant. For example, if a pool contains 10 ETH and 10,000 USDC, the constant K equals 100,000. This creates a hyperbolic price curve where the product of X and Y always equals our constant K. When a user trades tokens, they add to one side of the pool and remove from the other while maintaining the constant product. Larger trades face increasing slippage because they move further along the curve. Let's see what happens if we trade 5 ETH instead. Trading 5 ETH doesn't give us 5,000 USDC as we might expect from the initial price. Instead, we get 20,000 USDC. This difference demonstrates slippage, the difference between expected and actual trade outcomes due to the constant product formula. The constant product formula ensures that liquidity is always available, but at a price that adjusts based on the size of the trade. This automatic price discovery is what makes automated market makers function without traditional order books. Impermanent loss is one of the key risks that liquidity providers face when participating in automated market makers. It occurs when the price ratio of tokens in a pool changes compared to when they were deposited. Let's consider a scenario where you deposit tokens into a liquidity pool. You add token A worth $1,000, which is 100 tokens at $10 each, and token B worth $1,000, which is 50 tokens at $20 each. The AMM maintains the constant product formula. In this case, X times Y equals K, which is 100 times 50 equals 5,000. Now, let's imagine the external market price of token A doubles to $20. The AMM will automatically adjust the token ratio in the pool to maintain the constant product of 5,000. As traders exchange tokens based on the new price, the pool composition changes. The number of token A decreases to about 70.7, while token B increases to 70.7. Let's calculate the impermanent loss by comparing two scenarios: holding tokens versus providing liquidity. If you had simply held your tokens, you would have 100 token A at $20 each and 50 token B at $20 each for a total value of $3,000. But as a liquidity provider, after the price change, you now have about 70.7 of each token. This gives you a total value of $2,828. The difference of $172, or about 5.7% of your initial investment, is your impermanent loss. The magnitude of impermanent loss depends primarily on the price change ratio between the paired assets. This chart shows how impermanent loss increases with larger price changes. When one token's price doubles relative to the other, as in our example, the impermanent loss is about 5.7%. If the price quadruples, the impermanent loss increases to about 13.4%. There are several strategies to mitigate impermanent loss. First, Choose stable or correlated token pairs that are less likely to experience large price divergences. Second, the trading fees collected as a liquidity provider can offset some or all of the impermanent loss. Third, newer AMM designs like concentrated liquidity can help optimize capital efficiency and fee generation. To summarize what we've learned about impermanent loss. Impermanent loss occurs when token prices change after you deposit into a liquidity pool. The greater the price divergence between the paired tokens, the larger your impermanent loss. Remember, the loss is impermanent because it only becomes realized when you withdraw your liquidity. Finally, trading fees and additional rewards from liquidity mining can potentially offset or exceed these losses. Concentrated liquidity, introduced by Uniswap v3, represents a significant innovation in automated market makers. Unlike traditional AMMs, where liquidity is distributed across the entire price curve, concentrated liquidity allows providers to focus their capital within specific price ranges. With concentrated liquidity, liquidity providers can target specific price ranges where trading activity is most likely to occur. For example, in a stablecoin pair, liquidity providers might concentrate their assets between 99 cents and $1.01. This focus makes sense because stablecoins typically trade within a narrow price range. The capital efficiency improvement is dramatic. By focusing liquidity where it's needed most, providers can use as little as 37% of the capital compared to traditional AMMs, while potentially earning higher fees. Concentrated liquidity creates dramatic improvements in capital efficiency, potential for higher fee earnings, and allows providers to customize their risk-reward profiles by selecting specific price ranges. Automated market makers serve a dual purpose in the DeFi ecosystem. Beyond facilitating trades, they function as on-chain price oracles. AM liquidity pools naturally reflect market prices based on user trades and arbitrage activities. DeFi protocols can query AMM pools to determine asset prices for various critical functions. These functions include calculating collateralization ratios, determining liquidation triggers, and valuing synthetic assets. To protect against price manipulation, many protocols use time-weighted average price mechanisms, or TWAP. TWAP averages prices over a period of time, making it much harder for attackers to manipulate the oracle through short-term price spikes. For oracle functionality to remain accurate, AMM pools require sufficient liquidity and trading volume. Low liquidity pools are vulnerable to manipulation, as smaller trades can cause significant price impacts. This is why TWAP and other mechanisms are essential for creating manipulation-resistant price oracles in DeFi. This oracle functionality is crucial for the broader DeFi ecosystem. Lending protocols rely on price oracles to determine collateralization ratios and trigger liquidations when necessary. Derivatives platforms use oracles to settle contracts and determine payouts based on underlying asset prices. Insurance protocols use oracle data to verify claims and calculate coverage limits. As DeFi continues to evolve, reliable price oracles will remain a cornerstone of the ecosystem's infrastructure.